Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Microsoft stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Microsoft produces computer software, consumer electronics, and personal computers. Its best known software products are Windows and Internet Explorer. The company's top hardware products are Xbox and Microsoft Surface touchscreen personal computers. They've made some big acquisitions such as LinkedIn and Skype. They're in the process of making their largest acquisition with Activision Blizzard. The company is headquartered in Redmond, Washington, and was founded in 1975. The ticker trades on the Nasdaq, Mexican Bolsa, Deutsche Börse, London Stock Exchange, Zicha, Vienna, EuroTLX, Swiss, Colombia, Santiago, Brussels, Kazakhstan, Sao Paulo, Lima, Buenos Aires, Hong Kong, Ukraine, and Bulgaria Stock Exchange. Let's get started with the model. This is a large cap company, 1.9 trillion market cap. They're trading at $260 a share, and they have 7.5 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have a ton of free cash flow in 2019, 38 billion, yet it grows every single year up to 64 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that also increases a lot from 39 billion to 72 billion. Revenue is a sales for the company, and that grows as well every year from 126 billion to 193 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that grows each year from 83 billion to 132 billion. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income, and that almost doubles from 2019 to the trailing 12 months. Below that is the interest they receive on their investments minus the interest they pay in their debt, which is almost the same. They had a net outflow of 81 million. You can see in 2019 and 2020, they received more interest on their investments than they paid on their debt because this number is positive. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income, which grows from 39 billion to 72 billion. This is the income statement from their latest 10Q. And this is the first quarter of 2022. Their revenue is 49 billion, 17 billion from products, 32 billion from services. Of the 49 billion of revenue, 17 billion was from server products and cloud services. 11 billion was from office products and cloud services. They control 21% of the cloud market. And this is a big market and it's constantly growing. Their product is Microsoft Azure. The only company bigger is Amazon at 33%. 6 billion of revenue from Windows, 3.7 billion from gaming, 3.4 billion from LinkedIn, 2.9 billion from advertising, and then enterprise services, devices, and other. The cost of revenue is 15.6 billion, so they have really good margins. R&D of 6.3 billion, marketing 5.6 billion, general and administrative 1.5 billion. So their operating income is 20 billion, their net income is 17 billion, and their earnings per share are $2.23, up from $2.05 in the first quarter of 2021. They have less shares outstanding in the first quarter of 2022 compared to the first quarter of 2021. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. And they generate tons of cash flow, 52 billion up to 87 billion. And they do spend a lot on CapEx, over $23 billion in the trailing 12 months. Operating cash flow minus CapEx gives you your free cash flow. And they use half their free cash flow to buy back stock. They bought back 27 billion in 2021, 23 billion in 2020, and almost 20 billion in 2019. When a company buys back common stock, It decreases the shares outstanding and makes your shares more valuable. They also pay down debt each year. They pay down over $9 billion in the trailing 12 months. Let's look at the capital structure. $163 billion of equity, $61 billion of debt. They're 73% equity, 27% debt. But they could pay off all the debt with the cash on their balance sheet and still have $43 billion of cash left over. This is their capital structure since 2015. The blue line is their equity balance, and the red line is their debt balance. So their debt and equity were pretty similar in 2017 and 2018. But ever since 2018, their equity has gone up quite a bit and their debt has gone down. Plus their cash balance is always higher than their debt balance, so it's like they're debt free. I gave them the middle whack on Finbox, 7.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 1.8 trillion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.6 trillion. We divide that by 7.5 billion shares. And we get a calculated stock price of $214. They're trading at $260, so they're trading at a 22% premium. It's a sell according to the model. The last time I did a video on Microsoft was back in July 2021. They were trading at $279. My valuation was $234. And you can see the stock has come down 20 points from $279 to $259. And my valuation is a little lower now, mainly because we're in such a deep bear market. Their revenue target for 2024 is $258 billion. And for 2023 it's $223 billion. And for 2022 it's $199 billion. And I continued that growth into 2025 and I got $290 billion. That's how I got their future revenue estimates. They convert on average 32% of their revenue into free cash flow, so I multiplied their future revenue estimates by 32%. That's how I got their future free cash flows. Simply, Wall Street's valuation is $434. They're saying it's 40% undervalued. 23 analysts priced this stock and the average price target is $357, the lowest $300, the highest $411. This is where the stock has been trading the last 5 years. Besides the COVID dip, the stock has only increased up until August 2021, and it peaked around $350, but the recent bear market has brought every stock down, so they lost about 90 points since that peak. They have a beta of 0.94, so the stock moves with the market. It's gone up 3% in the past 52 weeks, while the S&P is down 6%. The 52-week low is 243, the high is 350. And the stock is trading below its 50-day and 200-day moving average. And this is a really popular stock. Well over 30 million shares are traded each day. Pretty much all the shares outstanding are on float. 72% are held by institutions, and 1/2% of the shares are shorted. They pay a quarterly dividend that they raise each year up to 62 cents a share. And the yield is 1%, which is 26% of their net income, 29% of their free cash flow. And you can see they used to pay a 3% dividend back in 2012 and 2013. But it's been coming down mainly because the stock price has been coming up. The forecast is for their yield to be 1.1% in 2024. They've done 9 stock splits, a 2-for-1 in 87 and 90, a 3-for-2 in 91 and 92, and a 2-for-1 in 94, 96, 98, 99, and 2003. So it's been 19 years since they did a stock split. If you invested $10,000 into this company 10 years ago, I'm sure you'd be happy at over $100,000 today. That's a 975% return, a 27% annual return. In the past 12 months, there's been mostly insider selling, only one buy. I'm sure all these people that sold are really happy, because most of them are around 300. Some are a lot more than 300. 71% of the companies held by institutions, 29% by the general public, and a small percentage by other entities. Their employee count seems to go up little by little every single year. They currently employ 181,000 people. The biggest shareholder is Vanguard at 8.3%, then BlackRock, State Street, Capital Research, and Fidelity. Let's look at their financial ratios. They have a PE of 27, that's stock price over earnings per share, which is better than a market average of 30. Price to sales of 10.1, that's stock price over sales per share. A price to book of 12, that's stock price over book value per share, and a price to free cash flow of 31, that's stock price over free cash flow per share. They have an amazing return on invested capital of 55%. They can cover the interest payments with their operating income 39 times. A really good ROE of 45%. Their current ratio is 2.0, that's current assets over current liabilities, and a quick ratio of 1.9. They generated nearly $64 billion of free cash flow in the trailing 12 months. They have $76 billion of working capital, and they pay out almost $19 billion in dividend payments. So the company's really well funded. The best way to look at ratios to compare them to companies in the same industry. There are 146 companies in the same industry as Microsoft. And if Microsoft has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They're obviously the largest company in this sector because they're one of the largest companies in the world. Their market cap is bigger than the next 19 companies combined. They spend a ton in CapEx. They have a good debt to equity ratio. They pay a small dividend. Most companies in this industry do not pay a dividend. They generate a ton of free cash flow. Their price to book and price to sales is worse than average, but their PE and price to free cash flow are better than average. Their 5-year annual revenue growth rate is 15%, which is worse than average, but 15% isn't terrible. At least it's double digits. And they have a really good ROA and ROE. To summarize, I have them trading at a 22% premium. Microsoft is one of the most successful companies ever, so you really can't go wrong investing in this stock. But most investors are looking to 5x, 10x, 20x, and you really can't do that with a company close to $2 trillion market cap. You might double your money, but there's almost no chance of you losing your investment with this company. And I think it's a really small chance of you losing even half your investment with this company. It's possible in the short term if there's a huge bear market, which we're in right now, but this stock hasn't been doing that bad in the bear market. But over a several year time frame, you really can't lose with this company. I rank their free cash flows 10 out of 10, their revenue 10 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.